Chapter 4. Accounting Principles and End-of-Period Adjustments. Learning Objectives. After studying this chapter, you will understand 1. How accounting principles, conventions, broad guidelines, rules, and detailed procedures structure and organize recording, accounting, and reporting. 2. That the accounting principles can be classified around 4 objectives or requirements: objectivity, quality of information, prudence, and periodicity. 3. That the application of the matching principle requires end-of-period adjustments, end-of-period or adjusting entries, to be carried out to give a true and fair view of the situation of the firm through its statement of financial position at the end of an accounting period, its income statement for the accounting period as well as its cash position and its cash flow generation and usage during the period. 4. That adjusting entries are triggered by the passage of time, not from specific support documents or transactions. 5. That end-of-period entries are adjusting entries that reflect 1. Uncompleted transactions, such as revenues earned but not recorded, revenues recorded but unearned, expenses consumed but not recorded, and expenses recorded but not consumed. 2. Changes in value of fixed or long-lived assets. 3. Changes in value of current assets. 6. That end-of-period entries also include the recording of the value of ending inventories and, if needed, corrections of errors carried out during the period. 7. That these adjusting entries will be carried out anytime one closes the books, yearly, half-yearly, quarterly, monthly, etc. 8. That end-of-period entries are often mentioned and explained further in the notes to financial statements. The preceding chapter described how transactions are recorded during the year in the accounting process. We explained how data enter the accounting process and how they are recorded in the journal and ledgers. The overall objectives of the accounting procedures during the phase of recording are to ensure that all data recorded are both relevant to the description of the financial performance of the entity and relevant to the decision model of the decision makers. The descriptors of every transaction can be verified from source documents. The structure of the data in the ledgers is relevant to the business model held by the management and to their decision-making needs. Accurate, meaningful, and significant data can be extracted rapidly from the ledgers on a periodical basis. In order for the techniques introduced in chapters 2 and 3 to deliver data that meet these objectives, transactions recording follows a certain number of guidelines or principles, which are accepted by accountants around the world. This chapter will present these key principles, a broad term that encompasses conventions, broad guidelines, rules, and detailed procedures, around which accounting is organized. These principles apply to all accounting entries and provide a common foundation for greater understandability and comparability of financial statements. The matching principle, introduced in Chapter 2, is one of these principles. It is connected to the concept and definition of accounting period. The matching principle specifies that costs or expenses should be recorded and recognized at the same time as the revenues to which they correspond or they helped create, i.e., costs and revenues that are linked during an accounting period should be reported in the same period. What we have recorded in Chapters 2 and 3 were only the current operations of a business. However, the cutoff between periods, specifying to which of two sequential periods a revenue or an expense belongs, i.e., should be attached, will require carrying out end-of-period adjustments. These allow one to close the books of one period and open those of the next. This chapter will, therefore, also introduce these entries that are essential to the completion of the periodic accounting cycle. At year-end, adjusting entries, entries relating to ending inventories, correction of errors, and closing entries will be recorded. 1. Accounting Principles. As indicated in Chapter 1, accounting produces a social good, information. The output of accounting is aimed at a variety of users who use it in their decision-making. It is therefore crucial that a large number of users be able to understand the meaning of the accounting reports, and that these describe fairly the situation of the economic entity. Consequently, it is necessary that rules of the game be established and followed by everyone encoding the reality into communicable signals such as the accounting entries. These rules, as mentioned previously, are called the accounting principles. They form a coherent set, see Figure 4.1, of behavioral rules and guidelines that range from pure concepts to very operational guidelines about practice. Words used to refer to these principles vary between authors, between practitioners, and between countries. What we call principles are called elsewhere concepts, conventions, or assumptions. In countries of Roman law tradition, these principles are generally integrated in the body of business or company law or in legally enforceable accounting rules. It is notably the case in Belgium, France, and Switzerland where these principles have been adopted by the appropriate legislative bodies. In countries where the legal system is one of common law, such as in the Anglo-Saxon world, the power of these principles is most of the time derived from the consensus within the accounting profession and between it and the business world. In a given country, the set of principles is referred to, in short, as the local GAAP, Generally Accepted Accounting Principles, a concept defined in Chapter 1. We will therefore specify to which country's set of GAAP to refer to when it will be useful in understanding a specific real-world example. We will thus speak of US GAAP, or Dutch GAAP, or German GAAP. The trend is, however, to evolve towards a single set of GAAP, which would, in all likelihood, lead to increased international comparability between and greater ease of consolidation of financial statements. There are, however, to date, still two different main sets of GAAP, the US GAAP, largely influenced by the US financial market regulators, and the IFRS/IAS GAAP which reflects the views of a broad international community of users. There appears to be, especially after the market crash of October 2008 and its ensuing recession, serious effort toward unifying the two sets of GAAP. However, any choices or harmonization compromise between any components of the two sets of principles is quite political in nature, power play between financial markets among other issues. Whether or which one of the leading two contenders will dominate in the end or whether some compromise will be found between the two sets is, however, still pure speculation at this time. See more on this in Chapter 5. The two sets of GAAP are largely in agreement at the highest conceptual level but the divergences appear in their operational application. That is where the debate actually rages at this time. The principles shown in Figure 4.1 are essentially identical between the two sets of GAAP. It is useful to understand why these principles have been retained over time, as they help producers, and users as well, understand the value and the limits of accounting information. It also provides an opportunity to explore how the usefulness and quality of accounting information can be improved. The qualitative characteristics of useful information have been presented in Chapter 1. See Figure 1.5. Figure 4.1 aims at classifying the accounting principles in 4 broad categories based on 4 critical requirements or constraints information users place on accounting. 1.1 Main objective of accounting principles: give a true and fair view. The purpose of the financial statements is to give a true and fair view of a business financial performance and situation. In the US, the equivalent concept states that financial statements must present fairly, in all material respects, the financial position of the company, and the results of the operations and the cash flows. The term true and fair view does not really represent a principle per se but defines the intent of the adoption of the principles we list below, as shown in Figure 4.1. True means that the financial statements do not falsify or dissimulate the financial situation of the company at period end or its profits, or losses, for the period then ended. Fair means that accounts give all users the same complete, unbiased, and relevant information for decision making. There is, as a matter of fact, no officially recognized and generally accepted definition of true and fair as it applies to financial statements. The term is used broadly but never precisely defined. IAS 1, IASB, 2007-15, requires that financial statements present fairly the financial position, financial performance, and cash flows of an entity, without explaining explicitly the concept of fair presentation. We choose to say that true and fair is the result of the application of the principles we are now going to explore in further detail. 1.2 Objectivity. 1.2.1 Unit of measurement. Financial accounting only records transactions expressed in financial units: euro, pound sterling, US dollar, renminbi, ruble, dinar, etc. No principle prevents accounting from keeping accounts of value creation and value consumption in terms other than financial. 1. For example, it is conceivable to account for the environmental effect of a firm's behavior or its impact on the health of a population, and some specialized accounting approaches exist to handle such issues. See, for example, Savitz, 2006, Epstein, 2008, Willard, 2012, or the sustainability section in the current annual reports of firms as diverse as Air Liquide, Ricoh or UPS. However, all alternative valuation bases have a subjective component. The most objective common denominator between events and transactions is the financial measure of their economic impact, which can be expressed in monetary terms. Clearly, such limitation to recording only financial elements in transactions is a loss of the richness of description of the reality of a business situation. The fact that everyone uses similar valuation bases, subject to market-based currency exchange rates fluctuations, creates coherence and allows all users to understand each figure to mean about the same thing. In the notes to financial statements, some of the reality of the non-financial elements of the situation of a business can often be described in approximate monetary terms. For example, an environmental liability, such as, for example, all issues and possible liabilities relating to past uses of asbestos, might be estimated as a range of possible damages that might be assessed by a court. See Chapter 12. Footnoting is an effective way to achieve full disclosure by mentioning an issue and the risks inherent in its existence, while keeping the ambiguity of any monetary estimation out of the reported numbers on the balance sheet and income statement. The notes allow each user to interpret the possible impact of the non-financial information on their personal view of the financial position of the firm, and their decisions. To give the users a complete vision of the history of events that have shaped the firm's financial position today and allow them to estimate its evolution in the future, figures of different periods must be compared or aggregated. Accounting must therefore use homogeneous monetary units over time. Although the purchasing power of monetary units may change over time and between currencies, accounting implicitly assumes the purchasing power of the monetary unit remains stable. Accounts, for example, consider that a euro in 2013 is comparable to a euro in 2012 or 2011, and conversely. This assumption clearly facilitates the work of the accountant, however at the expense of a likely loss of relevance. As long as inflation remains within normally accepted limits, for example a rate of less than 3% a year and the same inflation is, more or less, applicable to both revenues and expenses and assets and liabilities, the loss of relevance is not perceived as dramatic. All users can recast the figures to reflect their understanding of the real situation of the firm. But since it is impossible to account for the way all people experience inflation, the accountant de facto ignores inflation. In cases where the hypothesis of modest inflation rate is not satisfied, specific methods will be required to keep the purchasing power of the monetary unit in line with reality, while attempting to separate the inflationary effects on profit and cash flows from the fruit of managerial decisions. 1.2.2 Basis of valuation and measurement. Measurement is the process of determining the monetary amounts at which the elements of the financial statements are to be recognized and carried in the balance sheet and income statement. Conceptual Framework, IASB, 2010, 4.54. Defining the numbers that describe the effects of a transaction involves the selection of a particular basis of measurement. A number of different measurement bases can be employed and even mixed to different degrees in financial statements. They include the following: IASB, 2010, 4.55. Historical cost. Assets are recorded at the amount of cash or cash equivalents paid or the fair value of the consideration given to acquire them at the time of their acquisition. Liabilities are recorded at the amount or proceeds received in exchange for the obligation, or in some circumstances, for example, income taxes, at the amounts of cash or cash equivalents expected to be paid to satisfy the liability in the normal course of business. Current or replacement cost. Assets are carried at the amount of cash or cash equivalents that would have to be paid if the same or an equivalent asset were acquired currently. Liabilities are carried at the undiscounted amount of cash or cash equivalents that would be required to settle the obligation right now. Realizable, settlement or liquidation, value. Assets are carried at the amount of cash or cash equivalents that could currently be obtained by selling the asset in an orderly disposal. Liabilities are carried at their settlement values, that is, the undiscounted amounts of cash or cash equivalents expected to be paid to satisfy the liabilities in the normal course of business. Present value. Assets are carried at the net present value of the future net cash inflows that the item is expected to generate in the normal course of business. Liabilities are carried at the net present value of the future net cash outflows that are expected to be required to settle the liabilities in the normal course of business. Historical cost is the measurement basis most commonly adopted by entities in preparing the financial statements, since it is the one that requires the fewest hypotheses. This choice is coherent with the philosophy of better approximate, unchallengeable, and understandable than more descriptive but debatable and difficult to interpret. Historical costing is usually combined with other measurement bases. For example, inventories are usually carried at the lower of historical cost and net realizable value, often referred to as lowest of cost or market valuation. Such a choice makes sense, especially in high-tech fields such as in electronic products where the cost of components, i.e., their price on the market, may fall very rapidly with volume growth and technology evolution. For example, prices of electronic components are said to decline by at least 20% every 18 months. It would not be fair to shareholders to describe an asset at its purchase price if the replacement value, or the resale value, is lower than the historical cost. We have to keep in mind that the objective of financial statements is to report to shareholders the financial situation of their investment. Overvaluation of inventories, even more so than their undervaluation, misrepresents the actual situation, i.e., the potential future cash flows. However, as we will see below, accountants will always shy away from the possibility of overestimation, seen as resulting from subjective and unproven assumptions, and prefer living with the risk of undervaluation, which accounting information users can correct on the basis of their own awareness of the markets. See Prudence Principle, 1.4. 1.2.3 No offsetting. Offsetting of opposite net effects of different transactions could hide some of the richness of the situation accounting is supposed to report on. Such practice would obscure the reality of the risks faced by the firm in each transaction. Two transactions may have the same absolute value effect with opposite algebraic signs. The net balance of these two transactions would, arithmetically, be zero. Such a presentation would not reflect the complete truth or reality. For example, an overdrawn account at one bank and a positive bank balance with another bank may have equivalent amounts, but the risks they carry, and the signals they communicate, are not equivalent. Accountants have established the principle that an entity shall not offset assets and liabilities or income and expenses, unless explicitly required or permitted by an IFRS, IAS 1, IASB, 2007, 32. For this reason all ledgers and specialized ledgers provide the richness of records where all details of all transactions remain unoffset against one another. Accounting is not only the way to report on the financial position of the firm, it is also the way to create and maintain a full archive of how such a position was achieved. Such an archive is essential for better understanding what went right and what went wrong, so that more performance can be created in the future. Example 1. If a business has two bank accounts, one in Acme Bank with a positive balance of 1,000 CU and a second one in Everyone Thrift Bank with a negative balance of 400 CU, offsetting would be to report a net balance of positive cash at bank of 600 CU. However, the no offsetting principle requires that the positive balance be reported on the assets side and the negative balance be reported on the liabilities side of the balance sheet. Example 2. If a business owes a supplier 5,000 CU and simultaneously has a claim on that very supplier for the same amount, for example, as the result of a down payment on another order, it would not make sense to offset the two events as they reflect different parts of the business. The debt will be on the liabilities side and the claim on the supplier will be an asset. Example 3. As a rule, fixed assets are reported on two lines that, theoretically, should not be offset against each other, even if, in addition to the detailed information, the arithmetic sum of the two lines can also be reported as net asset. One line reports the gross or historical value of acquisition of the asset and the second line reports the accumulated depreciation on the asset, i.e., its reduction in value through consumption. Even if an asset is fully depreciated, i.e., its net book value is zero, it should be reported as two lines as long as the firm has not physically disposed of it. In this case, the application of the no offsetting principle, for example, allows the financial statements users to evaluate the approximate expected average life of the fixed assets by calculating the ratio between the gross value and the depreciation expense, thus enriching his or her view of the condition of the firm. More on this in Chapter 7.